Welcome everybody to our YouTube channel called Fast CPA and Consultants. I'd like to introduce our CPA, Fulton Abraham Sanchez. Welcome, Fulton.
Thank you, Sarah.
If you're visiting us for the first time, a few months ago, we started this series called Tax Talk, and the topic of today is tax consequences of inheriting a foreign company in the USA. First question we have, what are the tax consequences of inheriting shares of a foreign company as a foreigner in the USA?
If you are inheriting shares and you're a foreigner in the USA, the only consequence will come is when you sell the shares. When you sell these shares, the broker will withhold 15% of the value of the sale. This is called FIRPTA. This is not a tax. This is a withholding. It's a retention. This retention, the broker dealer will send the money to the IRS, and at a year end, if this is an onerous amount of money that represents for you, you need to file a tax return and request a personal tax ID number to file the tax return, pay the taxes, and request a refund. Because usually the withholding that these broker dealers do from the amount of the sales is much larger than the actual taxes to pay. Because the actual taxes to pay are lower than the amount of the withholding, the FIRPTA withholding from the broker dealer, you need to file a tax return to claim the difference.
Understood. Next question. If the inherited company is still in operation, can that tax be avoided?
No.
Got it.
Because remember, the only way to pay taxes when you inherit the stock is when you sell it. So if you, going back to the first question, if you inherit the shares from a foreign company, from a company in the US, and you're a foreigner, nothing happens. There's no tax to pay because you need to sell the shares to be taxed. Going to the second question, if the inherited company is still in operation, when you receive the shares and nothing happens, there's no tax to pay. It is when you sell the shares that you cannot avoid the tax. So you will avoid the tax while you hold the shares and you don't sell them.
Understood. Next question. Is it necessary for the inherited company to have a trust?
No. Trusts are used. First of all, trusts are, the tax rate for a trust is 35%. So when you are considering forming a trust, you need to be sure that that is the vehicle. If you are a foreigner and you received the shares from the foreign company and you want to open a trust, the objective of that trust will be to keep the shares separate from you, meaning that you will not be taxed anymore for those shares. You have transferred the title of those shares to the trust. And then when the trust sells the shares, the trust will be taxed, but the tax of the trust will be different, will be higher. Now, if you have an objective to have it in a trust, meaning for the protection of the state tax, then yes, because when you're a foreigner and you own property in the US, either property, financial property like stock and shares, or real estate property like a house, or personal property like equipment, like furniture, and you sell any of those properties, you sell them, you will have a tax. And that tax is whatever is the capital gains. Now, what happens if you die? If the person dies, what happened with those assets? What happened with the shares? The shares will be taxable up to 40% after $70,000. This is the maximum for a foreigner in the US. When the foreigner dies, the maximum amount non-taxable when the foreigner dies owning assets in the USA, except for banks accounts are not considered state assets. Anything else, yes. The maximum amount is 40%. I'm sorry, the maximum tax rate is 40%, but the maximum amount that is non-applicable, the 40%, is $70,000.
Okay.
Therefore, if you want to protect the asset that you are inheriting, and at one point you transfer that to the trust. So if anything happens to you, you are fine. You will the assets will not be taxed because the assets do not belong to you anymore. The assets belong to the trust. That is a useful tool for foreigners, but only if that is the objective. If you're going to sell the property immediately, then there is no estate tax, because the estate tax is only when you die, and you will only pay capital gain tax that is up to 20%.
Understood. Next question. If I receive shares of an offshore company as an inheritance, do I have to pay taxes even if I am a US citizen?
No, you don't have to pay taxes when you receive the inheritance.
Okay.
You have to pay taxes when you sell the shares.
Okay.
The act of selling is the one that creates the tax event. If your uncle or your dad or someone says, here, 100 shares from Apple are yours, that's fine. Nothing happens to you, because if this is a gift, the one who is giving the shares to you is the one who are going to pay what is called gift tax. But sometimes gift tax is not is also for the U.S. citizen is also, it's just a report. There's no gift tax, because for U.S. citizen there is an exemption up to $5 million. For foreigners, it's only 70,000. That is from the previous question. That's why a trust is useful. But if you are a U.S. citizen and you receive an inheritance of foreign shares of an offshore from an offshore company, when you receive the shares, nothing happens. It is when you sell them. At that point is when the tax event happens, and then you have to pay capital gain tax.
Understood. And our last question. Having a trust can avoid paying those taxes?
The capital gains, no. That will
Okay.
not happen, because even if you transfer the taxes to the trust, the shares or the asset to the trust, when the shares are sold, the trust will pay taxes.
Okay. Understood. Those are all of our questions for today. Thank you, Fulton, for the information. If you have any more questions, you can send them to our email or social media. We have a private group on Facebook. We'll put the description down below, and we'll see you on the next video.
Thank you.